All right. Okay, so yeah, you will be taking exam 2. I finally got my question box open so I could see. All right, well tonight the plan is that we will review chapters 5 through 8, which will help you get ready for the second exam and hopefully help you to do well on the exam. I pulled out tonight some what are called 10-minute quizzes for each chapter, and I thought I would use those as review points. I hope that the screen is clear enough that you can see it. Can you read the screen that I have up? Can you see what it says, or does it need to be larger? Okay, you can see it. That's great. Okay, I may need to make it just a tad smaller so that I can actually get it all on my screen. All right. So at this point, let's think a little bit about what was in Chapter 5. It's amazing how long it seems like it's been sometimes when we are just going back to 4 chapters back to do the test. It seems we have forgotten a lot of what we have learned. In Chapter 5, we were looking at short-term investments and receivables. So these would be your current investments and your current receivables, such as current or as accounts receivable, short-term notes receivable, interest receivables, anything that is due within a year would be your short-term or current receivables. These items are considered to be more liquid, meaning we can convert them to cash pretty quickly. There are a couple ratios that we used in this chapter. We used the quick or acid test ratio, and we also used the days in receivables to see how quickly we collected the receivables. Another thing that we talked about was factoring receivables. This is when a company might have several accounts receivables on their books and they decided they needed to raise cash for some reason. So they sold their customers' receivables for a discounted price, or therefore called factoring, to someone else to collect those receivables, and then they banked the cash. We talked a little bit about credit card or bank card sales and how those are recorded, and that you have to record the credit card discount expense to that because you pay a credit card company if customers use their credit cards at your business. So I seem to be flipping through the chapter backwards. Let me flip to the beginning. We always want to remember that we need to apply GAAP. We need to match our revenue with the expenses that it took to earn that revenue. Proper revenue recognition. We also took a little short look at unrealized gains and unrealized losses and how those would be reported. We talked about the terminology of trading securities, being usually stock that we can go out and buy and sell on the open market. The current ratio was also mentioned, which is just simply current assets divided by current liabilities. When we talked a little bit, as I said, about proper revenue recognition, and when we're talking about proper revenue recognition, we are making sure that we record our sales revenue and any contra accounts that we have that go along with that sale, such as sales discounts, or we might have sales returns and allowances. A sales discount is a discount that we offer to our customer if they pay early. And a sales return and allowance is a return would be if you went and you purchased something and you decided you didn't want it and you returned it. And an allowance would be something like a scratch and dent. If we were going to buy an appliance and they offered to let us have $100 off of that refrigerator because it had a big dent in the door, then that could be an allowance. And those sales discounts and sales returns and allowances are both contra sales accounts or contra revenue accounts. Remember that contra means behaves the opposite. Therefore, as a sales revenue account would increase on the credit side per the rules of accounting, sales discounts and sales returns and allowances would then increase on the debit side, therefore offsetting the sales revenue account. So one thing to remember is if you were looking at an income statement, you would see gross sales minus your sales returns and allowances minus your sales discounts to equal your net sales. Okay. Now I'm just doing basic terminology through the chapter, and then we'll look through the quiz that I have up here as practice. There's different types of receivables, of course. And we also learned that we needed to keep good controls over cash. So when we are collecting cash on account, we want to keep good control over that. Another concept that's introduced in this chapter is subsidiary ledgers. If we have on our balance sheet an account called accounts receivables, that is a control account. That is the total of all of our customers' accounts and what they owe us. We have to keep a separate or a subsidiary ledger to know what each individual customer owes us. An example of this is on page 256 if you want to just review that before you sit down to take your test and get a visual of the difference between a subsidiary ledger and a general ledger. And remember, the account in the general ledger that then appears on your balance sheet is your control account. Perhaps the most confusing thing that we did in Chapter 5 was to look at the allowance method for recording bad debt or uncollectible debts. Anytime that we are making sales on accounts to our customers, we won't be able to collect 100% of that. Depending on our credit terms, we might have a better average than other companies, but then we may be giving up sales by having too tight a credit. So there are two methods when we are using the allowance method. We can use the income statement approach, which is the percentage of credit sales or the percentage of sales amount. Anytime you're using the percentage of sales amount, you would be given a percent based on experience of the company, and you would multiply the total credit sales times that percent, and that would be an amount of your adjusting entry. Your adjusting entry will always be uncollectible accounts expense as your debit and allowance for uncollectible accounts as your credit. That is an adjusting entry. Therefore, one of those accounts will be an income statement account, the expense account, and one will be a balance sheet account, which is the allowance for uncollectible accounts. That account is a contra account. It offsets your accounts receivable balances to get so your accounts receivable minus your allowance for uncollectible accounts on your balance sheet gives you your net realizable receivables, amount you expect to be able to collect. If we're using the balance sheet approach or the aging of receivables, then we would go through the whole process of doing an aging. We would look at each individual invoice that's within our company. There's an example of an aging on page 262 in your textbook. And once we have all of the totals of invoices that are due within 30 days, or due between 31 and 60 days, 61 and 90 days, or over 90 days in the example here in the book, we would then have, again, a percent that is based upon the experience of the company of how much they can collect when these invoices get that far overdue. And we compute a dollar amount, a total dollar amount, based on the aging that we deem to be uncollectible for the business. The difference between the percentage of sales method and the aging of receivables method is that you must bring the balance of your allowance account to the amount of your aging. So if I had a credit balance of $10 as my beginning balance in my allowance for doubtful accounts, and I needed my balance to be $98, then my adjusting entry would be for the amount of $88. So when I'm using the aging of receivables method, I must pay attention to the balance that's already in my allowance for doubtful accounts or allowance for uncollectible accounts. And when I'm using the percentage of sales method, I don't pay attention to that balance at all. I just multiply my number times a percent, and that's the amount I use. So that's the difference in those two methods, and something that you need to be able to remember to answer your questions and your problems, your multiple choice questions and your problems correctly on your test. And then when you get ready to write off a receivable when an allowance method is in place, then you do not do another expense entry. You simply debit your allowance for uncollectible accounts and credit the accounts receivable. If you have questions as we go along, please feel free to type them in the questions box, and I will try to monitor that and keep up with you and answer questions as we go. Okay, let's look through this little 10-minute quiz here. I did use this in my classroom yesterday. I had my students, I gave my students 40 minutes to just go through and answer these. I allowed them to use their books if they had time, just like they would be taking the test. I will tell you the results were not what I would have hoped they would have been, but I told the students that this just let them know how much they needed to study for the test. So let's just use this, as I said, as a review. So on September 5th, XYZ Company made a $2,500 credit sale due in 30 days. On October 1st, the customer requested and was granted an extension on the payment. The customer was required to sign a 60-day 5% note on the day of the extension. Payment was paid on the maturity date of the note. What is the entry on September 5th to record the credit sale? So I would like for you to type in the box A, B, C, or D. What do you believe the answer to this first question is? It wants to know, what is the entry on September 5th to record the credit sale? A, B, C, or D? A? I like your A? Yes, the answer to the first one is A, accounts receivable and sales receivable. This is an example, as you read through this problem, of where they've given you a lot of information, and then they go back and they ask you a question about the very first item. So in this case, the first is A. Okay, finally. I'm over here fighting with my question box, trying to get my question box to pop out like I want it to, so that I can actually see what you're answering. Okay, that's much better. So very good. The first one is A. Almost everyone got that right. The second one, we're going to refer to that same information that was provided in question 1, and they want to know what is the maturity value of the note. So we had the customer was required to sign a 60-day 5% note on the day of the extension. Payment was made on the maturity date of the note. Okay, so what is the maturity value of the note? Again, see if you can calculate that out for me. You're really going to have to think tonight. C? C is not correct. What I believe that you did is a year's interest, and it's only 60 days. You want to try that calculation again? It's a very common mistake when you're given a question like this to calculate a year's interest, but you need to calculate the 60 days. So just take the amount of the note, which would be $2,500, times the percent of 0.05 times 60, and divide it by 365. And that gives you your interest. Okay, so do you see what do you think the answer is when you recalculate? Very good. The answer is B. Okay, the third one. We're going to again refer to the same information, and they want to know what is the entry to record the extension as of October 1st. So what happened on October 1st was the customer requested and was granted an extension on the payment. The customer was required to sign the note. So which one of these entries under 3 would work for that transaction of where the customer was required to sign the note because they were granted an extension? I like your hmms as people are thinking. So this would have been originally recorded as an account receivable and a sales revenue. Your accounts receivable would have been originally recorded at $2,500 on the date, which was September 5th. Now it's October 1st, and the customer has requested an extension, and the company who was the seller required them to sign a note in place of that receivable. Okay. The 2521 was the maturity value of the note. Okay, so you've got the accounts right, but the note would have just been for the $2,500. Okay, because then when they would have paid that note off, the entry would have been to the company. The company would have then had cash of $2,521, interest income of $21, and the note receivable would have been zeroed out at $2,500. The last question on this is, what is the maturity value or the maturity date of the note? So remember, the note was issued on October 1st, and it was a 60-day note. So what would the maturity date have been on this? What date would they have had to pay it? Or would this company, in this case, have received it? What is the maturity date if it's a 60-day note that was issued on October 1st? Okay. The way that we calculate that is, first of all, it was issued on October 1st, so how many days remained in October? It's helpful to know that there are 31 days in October. So for October, it would have been 31 days minus 1 because it was issued on the 1st. So there were 30 days remaining in October. And then we needed 30 more days, and there happened to be 30 days in November. 30 plus 30 equals 60. It was due on November 30th. This is a real, I mean, it's really an eye-opener to stop back and look at these things. And it also shows how much is in the chapters that maybe even if you listened to my lectures from this week, that maybe I didn't even touch on them in those lectures. And even when you're in the classroom, we don't necessarily touch on every single thing that is covered. And so it's always amazing. So 5, what is the entry to record the receipt of the payment or the maturity on the maturity date of the note? So we know that this would be happening on November 30th. And I really already just said this. So can you tell me which one of these entries would be when the company received the payment, which would be on November 30th? How much cash would they have gotten? And what other accounts would be affected? And I'm encouraging each of you to work through this as you look at this and do this, because it helps you it helps you to see what's done. Okay, on this one, we already calculate the maturity value of the note. Remember, we went back and we calculated the maturity value of the note up here, and we determined that to be 2521. So if that's the maturity value of the note, then that's how much cash the company's going to get. So we've got B, that they get that much cash. Okay. B says they get that much cash. And D says they get that much cash. What else happens? Well, the other things that happen is, didn't we calculate the interest revenue to be $21? And how much is in the note receivable originally? If we go up here, we see that we put into the notes receivable originally $2,500. Do you see that? If I had put $2,500 as a debit into that note receivable, then I need to credit out $2,500 in order to make that, the balance in that note receivable account, be 0. If I don't, if I would have done this entry up here, if I had chosen B, then I would have had a credit balance in notes receivable for $21. Okay, so the correct answer to this is D. Okay. Now we get to go on to some different ones, because that first problem was just so much fun. We couldn't hardly stand it. So question number 6, when an accounts receivables account has been determined to be uncollectible, the entry to record the write-off using the allowance method would be, okay, I would always recommend anytime it's asking you about a journal entry, what does it say? Let me reread this. I lost my train of thought. When an account receivable account has been determined to be uncollectible, the entry to record the write-off using the allowance method would include, okay, so would include, the include. Anytime it's giving you half of a journal entry, then I think it's very, very beneficial to, before I even try to choose my answer, say, how would I write that off? So how would I write off an entry to that? Do you know what the accounts would be? What I would debit to write off an uncollectible account receivable if I was using the allowance method? What would I debit? Do you know? I talked about this when I was rambling through the chapter before we looked at the quiz. So I'm not going to be able to collect an account receivable that's on my book. Would I need to get that account receivable off my books if I'm going to determine it? Okay, so what's the normal balance of accounts receivable, debit or credit? The normal balance. Okay, the normal balance of an accounts receivable is a debit, so I would need to credit it. Okay, an accounts receivable is an asset. Assets increase on the debit side, and the debit side, or the increase side, is the normal balance. And so I said, what is the normal balance of accounts receivable? The normal balance of AR happens to be a credit. See if I can write, let's see if I can make this happen. So if I say allowance, that's funny. If I call that the allowance, and this is my AR for accounts receivable. So my allowance for doubtful accounts is my debit, and my accounts receivable is my credit. That's the entry that you do to record the notification that I have a bad debt when I'm using the allowance method. So once I know that, then I can look over here and see which one of these answers is correct. Whoa. And I have a debit to the allowance for uncollectible accounts. All of the others would not be correct. So the answer to 6 is C. Which of the following about factoring of receivables is false? So it's 3 of these would be correct, 1 would not be. The seller loses control over the collection process. The seller receives the amount of the receivables less the financing expenses charged by the financial institution. Factoring is opposite expensive compared to the cost of retaining the receivable on the books. And the seller receives the full value of the account receivable. One of these is false. Do you know which one is false? Okay. What a factoring is the selling of receivables. Okay. So if you were going to buy my receivables, if I had $1,000 worth of receivables on my books, would you want to pay the full $1,000 for those receivables? You wouldn't want to, because those probably are not all collectible, correct? Some of those are probably bad debt. So you're not going to want to pay that. So you would pay maybe 90% of that value, so maybe $900 for those $1,000 worth of receivables. And then if you could collect those, then if you collected $950, you made pretty good money. Usually you wouldn't pay 90%, you might pay 60%. And then if you collect 90%, you've made good money. So that's basically how these things work. So what I just described, if I'm the seller, if I sold you my $1,000 worth of receivables, would I have control over those receivables anymore? I would not. You would have control of those receivables, right? So then, right. So I also just described, if we look at D, I said, and you told me you wouldn't want to pay me $1,000 for my $1,000 worth of receivables because they wouldn't all be correct or collectible. So with that said, the answer would be D. The seller receives the full value of the accounts receivable is the false answer. All the others are true, okay? Available for sale securities are reported on the balance sheet at. I'm going to go through some of these definition ones so we have time to get through all of these. I'm glad you enjoy how I explain things. I think it's really helpful that you hear some things in terms other than what the book says sometimes. So for number 8, the available for sale securities are reported on the balance sheet at. By definition, we report available for sale securities at fair value. We talk about that again when we're in Chapter 8. So fair value is how we report investments in available for sale securities on the balance sheet at fair value. An unrealized gain occurs. When does that occur? If the fair value of the investment is greater than the current recorded value, that's when we have that unrealized gain. Okay. If it were less than the investment, as what it says here in B, it would be an unrealized loss. It's only a loss or a gain when we sell it. And 10, which method of writing off an uncollectible account does not violate? So here it's not violate the expense recognition principle. And the answer to that is the allowance method. The allowance method does not violate the expense recognition principle. The direct write-off method does. The reason the direct write-off method violates the uncollectible or the expense recognition principle is we're supposed to match our revenue up against the expenses it helps earn. That's why we do the adjusting entries for the allowance for uncollectible accounts, because by doing the allowance adjusting entry as we do at the end of each period, we are saying, okay, maybe 3% of my accounts receivable aren't going to be collectible. I don't know which of my customers aren't going to pay me, but I know based on historical data, 3% of them are not going to pay me. So because of that, I'm going to go ahead and record 3% of my receivables as an expense so that I match it up with that revenue. If I don't do that and I just wait, and at some point in time I say, oh, Company A filed bankruptcy on me, they've owed me that money for a year, that means that I have recorded that revenue a whole year ago. And so if I recorded the revenue a year ago and I'm just now getting ready to record the expense, I did not match that expense and that revenue against each other. I hope that makes sense. I don't know if it does or not, but that's the reason that we have to use the allowance method. So that was a quick review, or not so quick maybe. It felt relatively painful to me. Review of Chapter 5. Chapter 6. If you recall, Chapter 6 was the good old inventory chapter. So with inventory, we talked about cost of goods sold, doing an income statement for a merchandising company so that we had our sales less our cost of goods sold to get gross profit before we went on to calculate our operating expenses and then our net income. So when we get into talking about that, then we have to determine how do we price that inventory, or how did we cost that inventory. And I often talk about, how do we want to, maybe it helps us to understand the methods by thinking about how the flow of the goods would be through the store. If it's FIFO, first in, first out, if we're in a grocery store, which sections of that grocery store do we want, or departments would we want to be using FIFO for the flow of the goods? And typically, I want my dairy to be first in, first out. If I'm the business, I don't want to be selling the newest milk first. I want to be selling the oldest milk to my customers first so that I can keep selling my product. And produce, you would want to be first in, first out. That would be the flow of the goods. But when we are doing inventory costing, we're not really looking at the flow of the goods. We are looking at the flow of the cost. And therefore, we just determine, if I want my produce to be costed out at LIFO, last in, first out, that's fine because I'm just looking at the cost. I still want my employees to be out there putting the oldest vegetables out for the customers to buy first so that everything remains fresh enough to sell. But I cost based on LIFO or FIFO or average cost. I cost the flow of my inventory. And those are, that's the main gist behind this, is tracing the flow of the goods. So let's look a little bit. This doesn't go into the actual process of calculating the costs very much in this. So hopefully we can get through this and we'll come back and do a quick review on that at the very end. So this is a lot of definition more. The excess of sales revenue over the cost of goods sold is, and again, I'm going to go through these definition ones because this is purely just the definition. The excess of sales revenue over cost of goods sold is gross profit. That'd be the first three lines on my income statement. The perpetual inventory system. So the difference between perpetual and periodic, this would be a question to ask you if you understood that. Perpetual keeps a continuous record for each inventory item, is used by most businesses, requires an annual count of the inventory on hand, or all of the above. All of the above are perpetual inventory. Very good. Now we're on a roll. Cost of goods sold. This is kind of question, if you can remember from this chapter, that they really like to ask you about inventory. Cost of goods sold will always be lower when using LIFO rather than FIFO during a period of rising prices. Is the number of units of inventory sold multiplied by the cost of unit of inventory? Is the number of units of inventory purchased multiplied by the number of unit of inventory, or will it be the same amount when using LIFO or FIFO? That's right. Well, I say that's right. The cost of goods sold, the reason it's not A, will always be lower when using LIFO rather than FIFO. I like to, again, I'm a very visual learner. So as a visual person, I have to sometimes give myself examples when I'm taking a test. So if I was going to look at this question and I wanted to eliminate A, I'm saying my cost of goods sold will always be lower when using LIFO rather than FIFO. So I'm just going to say, okay, I have some inventory. It cost me $1, $2, then $3, right? And let's just say I had one unit of each one. I had one unit that cost me $1, one unit that cost me $2, and one unit that cost me $3, just to keep it really, really simple. And let's say I sold 2 units. if I sold 2 units and I was using FIFO, I would have sold these 2, right? Last in, first out. My cost of goods sold would have been $5. If I was using FIFO, I would have sold these 2, because another collar. My cost of goods sold would have been $3. Okay? If it were asking me my ending inventory instead of cost of goods sold, A would have been the answer. Oh, you can't see the Excel sheet. Oh, come on. You don't have like 120, 100. No, I guess it would be like 0, 0 vision, wouldn't it? Is that better? Can you see it now? Can you hear me now? Yeah. Okay. So at any rate, what I was saying was if I was using LIFO, if I'm saying I had one at $1, one at $2, one at $3. That's what I was saying. If I'm using LIFO and I sold 2 of those, I would have sold these 2 yellow ones, right? Last in, first out. So my cost of goods sold, which is what it asked me for here, my cost of goods sold would have been $5, $3 plus $2, okay? And then I said to illustrate the FIFO, if I would have sold, based on FIFO, I would have sold these 2. So my cost of goods sold would have been $3. So my cost of goods sold was higher when I was using LIFO rather than lower when I was using LIFO. So that's why that first one isn't the correct answer. And it also gives you a little bit of real simplistic look at how LIFO and FIFO works. So at that rate, so cost of goods sold, it's the number of units of inventory sold multiplied by the cost per unit of inventory. It's the only one that can be correct there. I'm sure you answered quiz questions, right? That looked similar to this one. And I think that you will have test questions that look similar to that one. But you've just got to be really careful with how you read it, okay? Number 4, merchandise inventory. This one, I think that this one, if I can remember right, all of my students in my face-to-face class yesterday morning got it wrong. So merchandise inventory is the cost of inventory that has been sold, is an expense on the income statement, is neither A or B, or is both A or B. What do you think? I'm just curious to see if you can get this one right. Okay, and the answer to that is no, right? So merchandise inventory is an asset, okay? It is not the cost of inventory that has been sold. That is cost of goods sold. Cost of goods sold happens to be an expense on the income statement. So the answer to this one is C, neither A or B. And the reason it is C is because merchandise inventory is an asset. It's not an expense. It's not a cost, it's not an expense, it is an asset. It goes under the asset section on your balance sheet. Okay. This is about as close as it gets to inventory in doing inventory calculation in this particular little quiz, but this interesting how they present this, and it checks your understanding of if you know how inventory works. So here's your inventory account. You had a beginning balance of 10 units at $22. You had 2 purchases, 50 units at $25 and 40 units at $35. You sold a total of 75 units. So it's important to know that you sold 75 units. You had a total of 100 units available for sale at one point in time. Okay, I made it mad. 10 units plus 50 units plus 40 would be 100 units. Okay? So we had 100 units available for sale, and we sold 75. This first question is asking you, however, using the average cost method, what is the average cost per unit? How do we do that? I'm going to bring my trusty dusty little. Okay, so how am I going to do that? How do I get average cost per unit? I need to know my total cost, and I need to divide it by my total units. They already have our costs figured out here, so we can say 220, 1250, 1400. I can sum those up. To get 2870, and I need to divide that by 100. Or not by 100, yeah, that's right, by 100. Making up numbers. And that gives me 2870. My answer is 2870. Okay? And to do that, again, I added up 220 plus 1250 plus 1400. That's my total cost available for sale, and divided it by my total units available for sale, which were 100, to get my average cost per unit of 2870. The next question it asked me refers back to that, and it wants to know, using the average cost method, what is the cost of goods sold? So we had 2870 per unit times 75 units that we sold. So plus this times 75, 2152.50. Is this making sense? Okay, good. And then on 5, it says, what value is assigned to the ending inventory if using FIFO? Now, suddenly we've jumped from average cost to first in, first out. And they want to know, what is the assigned value to the ending inventory if using FIFO? So how many units do I have left in ending inventory? Well, if I had 100 to start with and I sold 75, I've got 25 units left. FIFO means the first one I buy are the first ones I sell. So if I sold 75, if I want to look at the 75, I could say, well, I sold these 10, I sold these 50, that made me have 60, I sold 15 more, and that leaves me 25 at $35. Or I could just look and say, I have 25 left. I know they have to be my oldest units. Did I have more than 25 here? Yes, I did. So it's 25 times 35. 25 times 35 happens to be, it's kind of unfair because I've already got all my calculations done on a paper in front of me. I'm just trying to show you, but 25 times 35 is 875. So my cost of ending inventory is 875. And then this is a separate problem moving forward. You can't see number 7. Can you see number 7 now? Okay. It said refer to question 5 and what is the assigned value of the inventory using FIFO. And that's where I said I bet you can't see them if I don't have it scrolled up on the screen. I bet it's really hard to see when I don't move my screen around. Okay, number 8. Number 8. This is we're going to refer to this same information for the next 3 questions for 8, 9, and 10. The Eunice Manufacturing Company had the following records. They had net sales of $217,000, beginning inventory of $15,000, net purchases of $40,000, and ending inventory of $20,000. What is the cost of goods sold for this company? Are you waiting for me to tell you? Maybe I can do it this way. How do I do that? Yeah. Okay, cost of goods sold. When I'm using inventory, perpetual inventory method, then I'm looking at my inventory records and I'm calculating my perpetual inventory, and I actually record it as a cost of goods sold. I have a cost of goods sold account in my chart of accounts on my general ledger, and I just record into cost of goods sold. If I'm using periodic inventory method, I don't record into a cost of goods sold. I have no cost of goods sold. It's a calculated number. So I have to know how to calculate cost of goods sold. And the way that I calculate cost of goods sold is my beginning inventory plus purchases. It says net purchases in the problem because net purchases would be purchases less purchase discount, less any purchase returns and allowance. You know how I talked about in the last chapter, I talked real quickly about sales returns and allowances and sales discounts. If one company, if the seller has a sales discount on their books, then the purchaser would have a purchase discount to offset that. Okay? Okay. I'm glad you're writing notes. That's the whole purpose of going through this, right? To try to figure this out. So beginning inventory plus net purchases minus my ending inventory oh, it won't let me do that. Minus ending inventory equals cost of goods sold. Okay, so in this case, it would be my $15,000 plus $40,000 minus $20,000. Oh, I think you're ahead of me, aren't you? $35,000. So once you know the formula, you can do it, right? Okay, the second one refers to question A. What is the gross profit for this company? So we know our sales minus cost of goods sold equals gross profit. So if I know sales are $217 minus cost of goods sold equals gross profit, what's my answer to this one? So again, sales minus cost of goods sold. Sales minus cost of goods sold equals gross profit. So here's my sales, the $217. We just calculated cost of goods sold, or you did, at $35,000. So what is my gross profit? Sales minus cost of goods sold. Okay, very good. And then here, this is just another, I said 10 went with it, but I guess it didn't, did it? 8, 9. Yeah. So 10 is just a definition for inventory turnover. inventory turnover, what does it tell us? Well, it tells us how quickly inventory is sold. It is also the ratio of cost of goods sold to average inventory. The formula is cost of goods sold divided by average inventory, making the answer both A and B. Okay. It's chapter 6. Moving on to Chapter 7. Chapter 7 was the fixed asset. We talked about depreciation. Was depreciation confusing to everyone? Yeah, so no. Okay, so with depreciation, we'll talk about this and we'll try to do some review real quick too. With depreciation, the whole purpose of it is to allocate the expense of that asset or that fixed asset over its useful life. Again, we have to remember we want to try to match up the revenue and the expenses that it took to help earn that revenue. So, that's how we would make the decision as the accountant of what method of depreciation to use. If it was something that, it's got a 10-year life and we use it pretty evenly over those 10 years, and we're going to just do straight lines. Straight lines very easy. Takes less time in the accounting office to compute it. And as we know, time is money. So at any rate, we would determine that would be good. If it's an asset that we would use more in its early years, we might say, we need to do an accelerated method of where we use more depreciation up or more expense up in the early years because we won't use it as much as that asset gets older. That might happen just to help you have an idea of, let's say that you were just a furniture store and you owned 5 delivery trucks to deliver the furniture, and you just had a delivery staff, and really they could go out and take any truck they wanted to take each day, to deliver. And maybe you buy a new truck every 3 years. So some of your trucks are getting pretty old, right? Some of them might be 15 years old. Do you think if you were a delivery crew and you had a choice to go out and use the newest truck versus the oldest truck, that you might tend to take the new truck? Well, I think that if it's not my vehicle, people would probably, if I'm paying people to deliver furniture, they're probably going to grab the new truck. So they're going to put more miles on the newer trucks than they are the older trucks, if that is the theory that they want to go after. If it's, I don't know about you, but if it's me and I buy a new vehicle and I still have the old vehicle, I tend to drive the old vehicle more than the new vehicle to save miles on the new vehicle. So in that case, straight line would make more sense. Let's look at these examples here. So the business purchased an asset that had a total cost of $110,000 and a residual value of $10,000. The asset is expected to service the business for a period of 10 years or produce a total of 1 million units. The machine was purchased on January 1st of the current year and has been in service for 1 complete year. Okay. So what is the depreciable cost of the asset? So the depreciable cost of the asset, again, this is definition. Do we understand what the term depreciable cost means? The depreciable cost is the amount we are going to delete, to depreciate. So there's no really formula for, well, I guess there is. The formula for depreciable cost would be cost minus residual. Okay? So the depreciable cost is cost minus the residual value. So in this case, the cost minus the residual value would be D. Okay? Using the straight line method, what is the amount of depreciation for year 2? Now it's asking us for year 2, not year 1, and it's straight line. So for straight line, it's cost minus residual, right? Or the depreciable amount, divided by life. In this case, it would be in years. Oh, I made that pretty. Not on purpose. Okay. So cost minus residual, we already determined was 100,000 divided by life in years. Our life in years was 10 years. So 100,000 divided by 10 years. This is a straight line. Okay. So when they say year 2, I will tell you this is something that tripped up students in my classroom again yesterday. They said 20,000, right? But it didn't trip you up because you say it's A, and that is correct because it's $10,000 each year. Okay. The next one says, now assume the business uses the units of production method. If the asset produces 250,000 units in year 1 and 200,000 units in year 2, what is the amount of depreciation expense for year 2? Okay, in this one, the formula is cost minus residual. Oh, I'm getting really fancy here. Okay, divided by life in units. In this case, our units are just units. They're not miles or anything. It tells us they're units. And that's going to give us a per unit cost. Okay, can you get me a per unit cost? So my life in units, if I go back up here, total was 1,000,000. So it's going to be cost minus residual to get 100,000 on the top divided by 1,000,000 to get a unit cost. That happens to be 10 cents per unit. I can't make a period. There, 10 cents per unit. Okay. With my 10 cents per unit then, in year 2, we used it to 200,000 units. So 200,000 times 10 is going to be 20,000. Do you see that? Tricky. Yeah. It is not, okay, I don't know if it's tricky or not. To me, it's not tricky, but 10 cents per unit so that we can get the 20,000. There's another way that you can do this, but I think it's good to get used to doing it this way. It helps you when you get ready to do depletion and things. So cost minus residual divided by its life in units to get its unit cost per unit. And then you multiply that times the number of units that were used in a year. Now, the next question is maybe tricky, okay? What is the book value of the asset at the end of year 2? So again, we're looking at year 2, and we are using the units of production method. So we've got to make sure we understand what book value is. So what is book value? Book value is cost minus accumulated depreciation. I'm going to sort of, okay. Cost minus accumulated depreciation equals book value. right? So we have to compute. We know what it is in year 2 under units of production. In year 2 under units of production, it was 20,000, right? Oh, I wanted to say year 2, so just, ooh. Okay, never mind. Undo. I know there's an undo button. Okay, year 2. But we need to calculate year 1. Year 1 had 250,000. So 250,000 times 10 cents is going to be 25,000. So our cost was 110. I don't know why I keep doing that. Lessons learned. Okay, it's smarter than me tonight. Oh, that's a big 0. 110,000. Okay. Minus 25,000 plus 20,000 is 45,000. So that's going to be 110,000 minus 45,000 to give us 65,000. Do you see that? Because in year 1, we would have had to take it 250,000 times 10 cents to get 25,000. Our adjusting entry at the end of year 1 would have been depreciation expense, 25,000, accumulated depreciation, 25,000. Year 2, we would have calculated it for the 200,000 times 10 cents. Our adjusting entry at the end of that year would have been depreciation expense, 20,000, accumulated depreciation, 20,000. So as we post those two entries into the T account, accumulated depreciation, year 1 would have had 25,000, and year 2 would have been 20,000 to equal 45,000. Whatever our asset was listed at when we bought it would have been what we recorded it on the books. That's an A, believe it or not. And that was 110,000. So 110,000 minus 45,000. Yeah. That's what happened because that's what happened in the classroom. It always helps me because I've worked through the classroom with staff a lot of times before I sit down in front of the computer to do this with you online students. And it helps me to see what's tripping up students, and it helps me to be better for you. But in this case, this is truly testing your concept knowledge. And it's basically, it didn't say, what's accumulated depreciation? But it asks, if you didn't know that accumulated depreciation is a contra account to that asset, that it offsets that asset account, and that's how you get your book value, you would never get this question right. So hopefully that when we go back and go through this, it doesn't make sense to everyone, though, as we work through it. I see more than one person doesn't understand or thinks they would have missed this, but doesn't make sense as you go through it now. Maybe not. Okay, are you writing down notes about this as you go? because my notes are going to be really, really hard to read. Okay, so if it makes sense to you now, that's what's important. Yeah, it makes sense. You know, it's important as long as it's ringing a bell in your head now, and that'll help you. I'm going to always advocate that you have to study for your exams. You know, just because it's open book, don't think you can go out and do it. But reviews like this should be helpful. The problems that they ask you won't be set up just like this, but it still is helpful to review the terms and the concepts. Okay. Refer back to this case, and what is the depreciation expense in year one if using double declining balance? So here's another chance to review how another method of depreciation works. Double declining balance is an accelerated method. Accelerated means that there's more expense taken off in the early years. The other thing to think about with any accumulated depreciation, or not accumulated depreciation, accelerated depreciation, is that you don't consider the residual value up front. If that makes sense. We don't subtract off that residual value before we start the depreciation process. We just have to make sure that our book value does not go below the residual value at the end of the process. So how do we do double declining? The formula is book value, book value times the rate and that equals the depreciation expense for the year. Depreciation expense. Okay, or for the period. I keep saying year, but we might be calculating it by the month. So book value times rate times depreciation expense. In the beginning of year one, the book value for this asset is its cost. Its cost because we don't have any accumulated depreciation. Its cost minus accumulated depreciation would be $110,000. The rate, for double declining balance, the rate is twice the straight line rate. The straight line rate in this case is 10%. How do I get 10%? 1 or 100% divided by the life. The life was 10 years. That equals 10%, 0.10. Twice the straight line rate, 2 times 10% would be 20%. So my formula is going to be 20% as my rate. So 110,000 times 20%. Let me pull back up my depreciation table or my Excel here. And let me just put it here. I think that you can see it better in Excel. So I said book value times rate equals depreciation expense. And I said my book value in the beginning was 110. My rate was 20%. So that would be $22,000 the first year. So in this case, it asks us in year one. So in year one, it would have been the $22,000. But let me show you if you, I don't know if you have the gist of how this works just yet. So my year one entry would be depreciation expense because expenses increase on the debit side. That would be my debit. My credit, would be accumulated depreciation. Okay. Then I would have in my accumulated depreciation account, T account, it would be $22,000 that first year. Okay, if I were going to continue this, I would then need my new book value. My new book value is going to be the cost minus the accumulated depreciation from that year, or the depreciation from that year times the 0.20. So year 2, it's 17.6. And I can continue this down. What did I do? Oh. Okay. I need to do a running sum. I want to just do something here. Okay. So at the end of year, 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. At the end of year 10, because my depreciation is, or this is my accumulated depreciation, I still haven't accumulated $100,000 yet. And I said my residual was going to be $100,000. At this point in time, I would do whatever I had to do in this year to make that entry be my book value be $100,000. What'll happen if I'm using higher depreciation rates is I'll run out of depreciation, so I can't go below my residual value. So it might be in year 9 if I were using a higher rate. Let's just say if I was using 40%. So if my asset had a 5-year life, then twice the straight line rate would have been 40%. And if I used 40%, let me just show you how we would have run out. Or where we'll see how we would have run out. One, 2, 3, 4, 5. In this case, by the end of year 5, if I had done the 40% each year, I would have used too much depreciation. So my last year would have had to been adjusted to make this number equal 100,000. So it would have had to been basically this minus the 1440 to make me come out. It wouldn't have been the whole 40%. So I just want you to be aware, because on some of the problems you could run out of depreciation when doing the accelerated, and students often make that mistake of taking off too much. Okay, 6. We need to zip through these so that you just have some review. But the entry to record the annual depreciation does not include a credit to accumulated depreciation. It always includes a debit. It includes a credit. On 7, to calculate the total cost of land, fencing happens to be a land improvement, not part of the cost of the land. On 8, the plant asset is sold and a gain is incurred. The entry to record the sale would include a debit to accumulated depreciation, because that asset, the entry would be cash account accumulated depreciation. I would have to get the asset off the books, whatever that asset is. Assets increase on the debit side, so I would have to credit it, and then my gain would be credited. Because gains behave like revenue, they increase on the credit side. How do I know I have a gain? If my book value is $1,000 and I sold the asset for $2,000, I have a $1,000 gain. Okay, based on, did I get more money than what my book value? Return on assets, this is just another definition. Return on assets is my net income divided by my average total assets. Remember that to get average total assets, I would look at my balance sheet and I would look at my 2013 and 2014 balance sheet totals. Actually, my ending balance for 2013 is my beginning balance for 2014. So I add those two numbers together and divide them by 2 to get an average. And on 10, intangible assets are amortized. This is a little tricky because it asks you which one is true. Plant assets are depreciated and natural resources are depleted. So they've got those two terms mixed around. We just did Chapter 8, so it should be a little more familiar to you. Ashley Corp purchased $600,000 of 4% five-year bonds at 97. That means at 97%. I paid $600,000 times 97% for these bonds. Or Ashley did. So that's $582. These bonds then were issued at a discount, which means the interest rate would have been paying higher. So in question 1, what is the amount of interest revenue recorded on July 1? That is going to be, and it told you the bonds were semi-annual. Yeah, semi-annual, so interest is paid twice a year. That means I would take my $600,000 times 2%, because interest, it says, pays 4% a year, so that's 2% every 6 months, or 2% semi-annually. So 600,000 times 2% is 13,000. Oh, this is a trick question. It's not really a trick question, but can't see quiz 8. Can you see it now? This is quiz 8. So 60,000 times 2% would be 12,000. This is one that I think would be easy to miss too. We had an $18,000 discount. That comes from, we paid the 97%, so we paid $582,000 for the $600,000 bonds. That would have been recorded. That would have been recorded up on the bond issue as bond receivables, bond receivable at $600,000. Discount on that of $18,000. The answer to 2 on this quiz, on number 8, the answer to 2 is B. The answer to 2 is B. And I was going to try to show you how. The cash interest is $12,000. And we had the discount of 18, and it told us that it was amortized straight line. So if this is a 5-year bond, paid semi-annual, that's 10 years. So we would divide the 1,800 discount by 10 to make it 1,800 semi-annually. So to get to this 13,800, we calculate the interest by doing 600,000 times 2% for 1,200 plus the 1,800 of amortizing the discount, and that's where the 13,800 came from. Okay, so 2 is B. Refer to question 1. What is the carrying amount of the bond on July 1st, 2014? There's another definition. So it was 600,000 minus the 18,000, but we just reduced that 18,000 by the 1,800. So we need to increase the carrying amount of the bond by 1,800. So it's 582 plus 1,800. The answer to that is 583,800. So 3 is A. Four, which statement regarding available for sale securities is true? A is true. Available for sale securities generally comprise up to 20%, but not including 20% of ownership. 5, when an available for sale investment is sold, the amount of the realized gain or loss is the difference between the amount received and the cost of the investment. Okay, that's definition 2. Which of the following is true regarding equity method? Another definition question. Both of the above are true. Under the equity method, when the investor company records its share of investee, how is that recorded? The answer is B. They need to record their revenue, and it increases their investment. For the consolidated balance sheet, the answer is D. And you can go back. Can I scroll up? How far up? Five was B. Six, 7, or 8. 6 is C. 7 is B. 8 is D. Okay. I could actually email this to you, Keisha. You're the one who's here asking all the questions. I can email you this without the answers on it. I don't have it with the answers on it. Would you like me to email you this without the answers for you to work through? All right. Are you just Kay Walker? Do you have a number after your email? Are you Kay Walker? 11, okay. Okay, after we get off here, I'll email you this file. It's a PDF that I can email to you. So it won't have the answers, but you can go back through and maybe try to answer them, then watch a video again and see if you have them right. So 8 was D, and then let's look at 9 and 10, and then we'll finish this up. So this is the present value, and it's just, do you know the difference between an annuity and the lump sum of $1 or present value of $1? So let's see if you can get these for me. So what amount must be invested today in order to have $600 at the end of 2 years? We're going to assume a 6% interest rate. So they give us two tables. They give us the 6% of $1 and the 6% of annuity. So we want to, at the end of 2 years, get $600. How much do I need to put in the bank today? That's 9. And then 10 is, how much would I have to put in the bank today? I'm going to put one amount in the bank, and then I'm going to get $600 at the end of year 1, $600 at the end of year 2, and $600 at the end of year 3, or a total of $1,800. So in the first, in number 9, I'm going to get $600 at the end of 2 years, and in the second one, I'm going to get $600 at the end of year 1, $600 at the end of year 2, and $600 at the end of year 3. How much do I have to put in today to make that happen? Do you know how to do these? Maybe? Okay. What do you think the answer is to 9? Okay, that's correct. How about 10? You don't know 10? Okay. 10 is an annuity. I want to know how much money I have to put in today in order to get $600 back in a series of payments. So that makes it an annuity. And it told us for each year for the next 3 years, we're assuming 6% interest. So this is our 6% table, and it's 3 years. So we simply take $600 times the 3-year factor, 2.673. Okay. And the answer is C. You're right. So just to try to help you think about this, if I were going to get back $1,800, it wouldn't be logical that I could just put $534 in, right? Not at 6% interest, I mean, because interest just doesn't add up that fast. So you should be able to eliminate A and B from something like this really quickly because it's just not logical. And it's important to gain logic. Did you have any specific questions you wanted to ask me? It's been the hour and a half, I know, and I know I've kept you hopping a little bit here, and I will email you this file, but is there any specific questions that you can think of, things that you're scared to death? But do study. It's really good to go do the self-checks in your textbook at the end of each chapter. All right, good. You'll have questions when you start taking the test, okay? So anyway, do the self-checks at the end of the chapters. The answers are there too, so you can do those. And then it's always helpful to go through the study plan and answer all of the QCs and Q questions that are in the study plan before you take your test, just to practice on your multiple choice. Yeah, the multiple choice are tough, and that's why it's tough because of the wording, and it's not because they try to trip you up. It's not that at all. It's even as we went through this, which was fairly basically worded, the wording gets you. So I tell students it's not always the accounting that makes it hard. It's the comprehension of the reading and understanding just what they're asking you. So if you knew what they were asking, it would be fine. Yeah. Yeah, you want me to be there to tell you what to do when you answer these. So anyway, did you do the study plan? Have you worked through the study plan on any of the quizzes or any on the quiz questions? You've been doing study plan at all? Before you do your quizzes, do you try the study plan? Okay, I see that if I can convince students to do that, their quiz scores improved. And of course, I have no idea how you're doing on your weekly quiz scores, but it usually really helps to just zip through. Terrible. Okay, it helps to zip through those quizzes each week, but it helps if you understand. If you don't understand, then you need to be emailing your instructor, right? And say, please help me with this. I don't understand why. Yeah, that's typical. So I don't want you to think that you're not a typical Accounting 101 student, because typical Accounting 101 students struggle with the quizzes. And I tell them that's because you've got the help. You can use the Help Me Solve It to work through the problems, and then on the quiz you don't have that. But thankfully the quizzes aren't weighted as heavy as the homework, so it helps to keep your grades up. But good luck, okay? Make sure you study. I personally like a paper book. I think it's easier with the paper book because I can go through and I can flag pages and have it ready to reference when I'm taking a test. So you might look at your ebook and see if there's any way that you can flag. Yeah. Okay. So make sure when you are doing any reviews for your instructors that you note that you don't like the digital. Okay. I don't know that it's a train that we're going to be able to stop, but you'll probably want to just slap me through the computer when I say that, but you do know you could have gotten a low print version of this book for a penny? Oh gosh, yeah. The Pearson book is available. I'm pretty sure it's a penny, or it might be $10. I think the Pearsons are a penny, and the McGraw-Hill books are like 10 cents. There's low-cost versions available for the ebooks. So, and they're not printed in color or anything. They're just print books, but you can get low print versions of these books. So keep that in mind. It may be a little late to try to do it this term, but if you have an ebook moving forward, and if you're an online student, you will, then you might want to look into getting the low-cost print. And you can usually find, there may be information right in the front of your ebook, or you can usually find it at the bookstore where you would go to order. There, it will have the option of buying the low print. Okay? Sorry. All right. Good luck on your test, okay? Okay, good night.